We're going to calculate the stock price for Cisco Systems. And the first thing is the market cap, 198 billion. Let's put that into the model. And then the stock price of 46.89. So now we know how many shares outstanding, because it's the market cap divided by the stock price is equal shares outstanding, 4.2 billion. So what we're going to do in the video today is we're going to figure out the intrinsic value of the company. And the way you do that is you estimate the future free cash flows of the company, and then you have to discount those cash flows back to today's dollars. Now you have the value of the entire company. And then you divide that number by the shares outstanding, and then you get the intrinsic stock price. And we'll compare it to the actual stock price to see if it's a good buy or if it should be a sell. And first we need the free cash flows for prior 4 years. And that's in Yahoo Financials. Go to cash flow and they list it right in the bottom. Free cash flow, the cash flow that's left over after operating your business. Next is net income, which is the profit or loss for a given period. And that's on the income statement, which is also in Yahoo. And the revenue is the sales for a given period, and we're going to take that number as well. And we always give a quick glance at the numbers. First, you want to make sure you entered it correctly. There's nothing that's an obvious mistake, and maybe look for some outliers. Look at this. They had 110,000 profit. Wait, let's double check that. 110 million in 2018. And the years before and after were about $10–11 billion. So they had a big difference in 2018. That's definitely correct. It looks like something that occurred in the normal operations, but that's something you should look into. And there's the big, they paid 12 billion of taxes in 2018 compared to 3 billion the prior years. So I'm sure if we looked at 10K, we could figure out what that is exactly. But I'm sure it's correct since it's in here. It's just something to keep in your mind when analyzing company. Now let's look at the capital structure of Cisco, so we know what to discount the future cash flows by. And the interest expense is on the income statement. That's 859 million. That's the interest they pay on their debt. Now let's see how much debt they have. We'll go to the balance sheet, go to liabilities, and then current liabilities, 10 billion of current debt. It's a big number. And 15 billion of long-term debt. Okay, that looks right. They pay 3.5% interest on their debt, but interest is tax deductible, so let's find their effective tax rate. Let's go back to the income statement. And income before tax is 14.5 billion, and the income tax is 3 billion. So the effective tax rate is 20%, so the cost of debt is 2.8%. Now, even though they have 25 billion of debt, they're such a big company, it's only 11% of the capital structure. So it's not too bad of a number. Now, let's figure out the cost of equity. First, we need the beta. And that's 0.95. It's a good beta because it's a strong company, Cisco. It moves with the market, their stock price. So the cost of equity is 9.62%, and we use a capital asset pricing model to get that. And the cost of debt is 2.8%. So equity is a lot more costly than debt, as you can tell, because equity is riskier because it's lower on a capital structure. So in the event of a default, debt holders are paid before equity holders. And in order to calculate the WACC, the weighted average cost of capital, you combine the debt, 2.8, and equity, 9.6. And you get 8.86. And that's what we're going to discount the future cash flows by. So we estimated the future free cash flows in year 1, 2, 3, 4. Then we did a terminal value, which is all the years beyond year 4. We discounted those numbers back to today's values using the WACC. And the value of the company is $211 billion. And when you divide that by 4.2 billion shares, we come out with a stock price of $50. It's trading at 47, so it's trading really close to intrinsic value. According to the model, it's a buy because it's trading at a 6% discount. And you can see the stock price has been fairly steady. It was up a little, maybe close to mid to high 50s, but it looks appropriate, the stock price, for what the company's worth. So this is not always the case. Sometimes you see companies worth nothing or less than nothing because they're not making any income. They're losing money every year, but yet their stock price is high. Then you'll see companies that are worth, the stock price is worth $200, but they're and they're trading at $50 or they're trading at $400. So it could be a really wide variance because people don't always look at the financials. They look into the future, which you should. You should look at both. And you have to give an idea of how the future is going to treat the company. And apparently what people are saying is the future will treat the company the same way it's been treating the company in the past, at around $50. So, as you know, everybody has their own opinion on stocks. This is just my model and my opinion. So thanks for watching.